Did you know that you could buy a house and let your neighbors pay your mortgage for you? It is possible. I'll show you how, and it's probably easier than you think. As a licensed attorney, who's not your attorney, what I can tell you is that real estate has some very interesting loopholes. One of which is called the primary residence rule, that you can get a mortgage for your primary residence. But what does that exactly mean? Part 1 to this rule is the number of units in your primary residence, and part 2 to this rule is the occupancy of this residence. Let's break this down, starting with the number of units. When most people think about getting a mortgage, they think about buying a single-family house, or they think about buying a condo. But your primary residence can also qualify if it's a duplex, a triplex, or a fourplex. Even the Fannie Mae website says that giving mortgages for 2, 3, and 4 unit properties is the key to affordable housing in the United States. Now watch this. Let's assume you do what everybody else does. You want to go out and buy a nice property. You go out and find this $1 million house, you put down $200,000 and you finance the other $800,000. You get a 6.5% mortgage. This is going to cost you around $5,000 every single month just in your mortgage, but at least you have a nice house. But if you get a little bit more creative, now you can do something different. Instead of buying this $1 million property, you could go out and buy this 4-unit property. And I'm just going to draw it up into this box where you have unit 1, unit 2, unit 3, unit 4. You come in and live in this 1 unit right here. It might cost you also $1 million to buy this 4-unit property. Now, yeah, you're not getting as big of a house. It's probably not as nice. You are a tenant in this building that you own. But see what happens next. You could put down the same $200,000. Yes, there are mortgages where you can put down a whole lot less, but let's stick with the $200,000 down payment, 20%. You pay 6.5% because again, you're getting a mortgage. You're not getting an investor loan or a commercial loan. This is your primary residence. You're living there. And now your mortgage payment is $5,000 a month. You have the same mortgage payment as here, but the difference is your neighbors in this building are now your tenants. And let's assume that you can rent out units 2, 3, and 4 for $1,500 a month a piece. That means now these 3 tenants would be putting $4,500 a month into your pocket out of your $5,000 mortgage, which means out of your own pocket, you really only have to pay $500 a month to live here while you're working to build equity in this property. But that's just the beginning, because what happens now if, well, you raise the rents? Now, instead of charging $1,500 a month, you charge, say, $2,000 a month because you invested your money into a good area where more people want to live. Well, now, instead of making $4,500 a month, now you're making $2,000, $2,000, $2,000, $6,000 a month in rent. Your mortgage is locked in at $5,000 a month. Well, now you're not paying $500 a month to live here. You're getting paid $1,000 a month to live in this property. Again, not as nice as this, not as much space. You have your tenants as neighbors, but you're starting to build more wealth because now you're looking at this as an investment property. But we're just getting started. Let's go back to this primary residence rule. Now that we understand that a 2-unit, a 3-unit, and a 4-unit qualify for this primary residence rule to get a mortgage, which means you can go buy a duplex or a triplex or a quadplex and pay less money because now your tenants can help pay your mortgage and potentially even be paid to live in the property. The other part that you want to understand is the occupancy requirements. Now, I do want to remind you that for those of you that are investors, my team at Briefs Media publishes a free daily newsletter called Market Briefs, where my team is working to break down what's happening in things like the housing market, stocks, economy, the global markets, and the crypto market into a fun, witty, and easy to read newsletter. We have hundreds of thousands of investors that are reading Market Briefs every morning. Plus, when you sign up for Market Briefs, you'll also get my investing masterclass where I'll show you how you can get started as an investor and find hidden investment opportunities free as a bonus just for joining Market Briefs. So if you want to get Market Briefs and my investing masterclass, all you have to do is click the link down in the description below to get them for free. When you get a mortgage, you have to fulfill an occupancy requirement which says that you are planning to live in this property for at least 1 year. That's what most mortgages say. But what does that exactly mean? Take a read. The FHA mandates that borrowers must occupy the property as their primary residence for at least 1 year. But what happens after 1 year? Turns out for most mortgages, you can kind of do whatever you want. So let's go back to this example. You go back to this $1 million 4-unit property, and then you rent out the other 3 units for $1,500 a month. Your mortgage payments are $5,000 a month, and you have to pay $500 a month out of your pocket because you're only generating $4,500 a month from your other tenants. You go through this for 1 year, your mortgage payments are only $500 a month out of your pocket because you have your tenants that are paying your mortgage for you, and then 1 year and 1 day later, you realize, I could move out of this property and do it all over again. And so now you move out of this building and then you move into a new building. You find another, let's call it 4-unit building. 1, 2, 3, 4. This time you want to be creative. So you move into the top unit. You move into unit number 2. Doesn't really make a difference. And then you rent out unit 3, 4, and unit 1. And you rent out these units again for $1,500 a month each. You bought this property for $1 million. Let's say your mortgage is again $5,000 a month. That means now you're paying to live here $500 a month because you're generating $1,500 a month, $1,500 a month, $1,500 a month. So you're generating $4,500 a month in rent. Your mortgage is $5,000 a month. You're paying $500 to live here, and then you rent out this unit to somebody else. And now you have an additional $1,500 a month in rent coming in here. That means your mortgage payment is locked in at $5,000 a month. You're making $1,500, $1,500, $1,500, $1,500. You're making $6,000 a month, which means you are profitable here. We talked about being profitable if you raise your rent to $2,000 a month. But if you move out, well, now you're still profitable. And now you can take the profits from this property and pay for the mortgage here. Because right now you have to pay $500 out of your pocket, which isn't bad, but you could cover that $500 from the profit that you have from this first property. And this is where it gets even more interesting, because a year later, you can do this again and again and again, as long as you're living in each property for at least 1 year and 1 day. Now I know what you're thinking. Well, Jaspreet, if I have to put down a 20% down payment every single year, how am I supposed to do this? Where am I going to find $200,000 every year? Well, then you have a couple options. Number one is you don't have to put down a 20% down payment. Now, I'm an advocate for you to have bigger down payments so you have less debt and more skin in the game, but the reality is because this is your primary mortgage, you can qualify for a much smaller down payment. 5%, 3.5%, 3%, sometimes even 0%. Because when it's your primary mortgage, you have a lot more options. The other thing that you can keep in mind, again, take this with a grain of salt, is that if you're buying properties in good areas, and property values are going up, well, then you can also do a cash out refinance to pull some of the equity out tax-free and use that money to buy another property. Because if you bought this property for $1 million, it goes up in value to, let's call it $1.5 million. Well, when the value goes up to $1.5 million, you can pull out $1.1 million tax-free. Remember, you bought the property for $1 million. You pull out $1.1 million, so you have all of your money back, and then you can use that money as a down payment to buy another property, and your tenants are paying that mortgage for you. This gets more advanced, and I don't recommend most people, the vast majority of people, to do this, but I want you to understand what the options are, because this is what some people do. This is how many people can get started with real estate without having to go out and buy their own rental property, because you could turn your home into your first rental property. And even if you don't want to go out and start with a 4-unit property, you can go out and buy a 1-unit single family house. It doesn't have to be $1 million house. It could be a $200,000 house. It does not matter. But the nice thing about this is you buy the house for you to live in. After 1 year and a day, you can move out and rent it out to somebody else. And because it is a primary mortgage, you have a lower mortgage rate, not a commercial real estate rate, which can allow you to make bigger profits, especially as you get started, because you're using the property first to live in, and then you're transforming it into a rental. And the key here is to stick with it, because real estate takes time. And now you can, if you do this correctly, work to stack the cash flow. That way you can start to build a portfolio of rental properties that start from places that you live. And then as you start to build more wealth, you start to see property values go up. You could potentially sell them and buy bigger properties. You can refinance them, buy more properties, or you can just take new cash and buy more properties to start stacking the cash flow and start accelerating the wealth. The slowest part is the beginning, but once you get started, you'll start to see more and more opportunities. Yes, it is difficult, but it's not impossible. And for some people, this is the way to get started, because it's a whole lot easier to be a house hacker than to go out and buy a rental property separate from the place that you live. If you have $100 in your bank account and you want to buy this $1,000 Gucci scarf, your bank would love to lend you the $900 at 25% APR, because when you make the minimum monthly payments, your banker gets richer. But that's just the beginning. When it's time for you to buy a house, who do you ask? How big of a house should I buy? Many times it's your banker, and they're not your financial